Hello and welcome to Trading Blows from TraderX. Another busy show this week. Plenty for us to discuss. Myself and the panel digest last week's key central bank decisions from the FOMC and the ECB, and also look at last week's US labour market report as well, what that means for the US economic outlook. And we also look ahead to this week as well. We've got a policy decision due from the Bank of England a little bit later on today. And of course, we have the ongoing jitters around the US regional banking situation, which continue to cause more than a few nerves in the financial markets. It's a busy show ahead, so without further ado, let's get into it. So let's meet the panel. As always, going head-to-head over 4 rounds. They'll score points for a great response and have the threat of points being chalked off if a dispute is raised over their answer. Of course, the better the response, the more points they will score. There has actually been a bit of a dispute going on Twitter this week around my scoring of the show. But as my boss said, I am God when it comes to the allocation of points. So the panel would do well to remember that as we move through the show. Joining us this week, he's on the show almost as often as me at this point, from down in South Africa, Arno, market analyst. We're also joined by Dick Matthews, senior broker from Pardus FX, the corporate and institutional FX delivery firm. And last but by no means least, Ioan Smith, a 20-year market veteran of sell-side banks and his own research firm as well. With all of that said and done, let's get into the first round. So we're going to do a bit of a world tour this week, and we're going to start with the United States. It was obviously a big week for US economic data last week. We had the non-farm payrolls number, a 13th beat versus the consensus in a row on the headline non-farm payrolls number, unemployment coming down quite nicely as well. And of course, in the mix as well, we had the Federal Reserve announcing a 25 basis point hike, but also a likely pause to the hiking cycle as we move into June and also into the second half of the year. Dick, I want to start with you. Firstly, on the Fed, I know you raised a similar point with Blake Morrow yesterday, our good friend. What are your thoughts in terms of the Fed? Is Powell on pause now, or do you think we could see a similar situation to that which we saw with the RBA, where we pause for a couple of months and then we start hiking again as a bit of a surprise?
Good morning, sir. Good point for calling to the host. Morning. Well, first off, although they both begin with P, pause and pivot, they mean two very different things. And I think the market's starting to get them confused. He's certainly pausing, and it doesn't mean that he can't come back again and hike rates up, which I actually think he may well do. And it's certainly not a pivot, so no U-turn there. Economy is still strong. Jobs showing 1.6 jobs for each unemployed person. Non-farm payrolls, I'll come on to in a second. So the economy is still bubbling away there, keeping an eye on money supply, which seems to be dropping really, really quickly. But having started off with a rant about pauses and pivots, my second rant is people are putting too much importance on the non-farm payroll numbers. They're a number, they get revised every month. I think this month, the last 2 months were revised downwards, so they ended up net much as they were. And we've never had an economy like this, or certainly not for 50 odd years, since 1973, to be honest, when we had the Vietnam War going on and the oil price shock. You've had COVID, and you've
that
got
must be just when you started in the city, Dick.
I had actually started in 1973, and 1st of October. So note it in your diary for the celebrations later on this year. But that's the last time you had such a shock to the economy. And how can you look at employment numbers and try and extrapolate anything from them? You know, it's almost as big a change to the economy with people working from home and hybrid working as the Industrial Revolution was. So I think people are getting it wrong when they look at the non-farm payrolls. However, I think we're probably going to see another hike, probably sort of back end of the summer. CPI may prove me wrong today, but I don't think it's falling nearly as quickly as they want it to fall. The PPI tomorrow, I actually think is probably as important, if not more important, than the CPI today. And the input number is starting to hover much lower, around about the 3 level. So that could be a sign that things are starting to turn. I guess the other argument for the recession is, I said, the money supply, which is dropping its quickest rate since the 1930s, which is before I was in the market, I would say. That's an extra point. I claim an extra point for every time we have a go at how long I've been in the markets. I just think that the markets are getting it wrong, and they're looking for pivot. They have been looking for pivot for months, and it's actually a pause. The other thing I think you're still going to watch out for is this debt ceiling. So I was saying to Blake last night, if I had $1 for every time there was a debt ceiling crisis, I'd be a very rich man. It comes and goes, and they get over it. It's brinkmanship. Maybe they're waiting for the stock market or something to crash, so they actually put their heads together and get something sorted. T-bills are an interesting play, but I'm not nearly clever enough to understand the logistics of doing that. And finally, I think that you asked about treasuries. They look really odd, don't they? They're 1.5% below the inflation level. It's yielding around about 3.5. So there might be an interesting play there. Certainly if inflation comes in bubbly today and PPI isn't as good as we expect tomorrow.
Yes, just to clarify on that point, we are recording this before the US CPI numbers come out. So do bear that in mind when you're watching this back. You mentioned about the Fed hiking rates. Obviously, that is a bold call, to say the least. It's certainly against what the market is pricing. I think it was around 70 or 80 basis points worth of cuts when I looked just before we started recording. So that was certainly set a cat amongst the pigeons. Ioan, I want to go to you. Obviously, we all know the non-farm payrolls number is your favourite economic data point. At what point do you think, how long do you think it's going to take for the lagged impact of all these rate hikes to really actually start to have an impact on the jobs market? Because from where I sit, things look remarkably resilient at the moment.
Yeah, my views on non-farm payroll. Like we said, the range from the market is incredible, and most of the time it's out of range. So I don't think you can put too much into those numbers. Like I said, for over 20, like never even bothered to look to see what the number. So you've got to look at the chart that I sent up last week, where he compared his job creation to all the other presidents, and it was that Lib Dem style chart. Oh, look how many jobs I've created. Well, completely ignore the fact that all the jobs were coming back after the pandemic. So I don't even put any store in that number at all. Like you said, in terms of the lagged effect, probably 9 to 12 months as these things start to come through. But going back to what Dick is, I mean, I'm predominantly focused on the money supply, which is obviously slowing very sharply in the US and in all Western sphere. So, I mean, this is obviously direct what's going on in the banking sector. Come to at the end of the show, like I said. But M2 is about $22 billion at the moment, and $17 billion is banked. I'll get back to that when we come to the topic towards the end of the show. But I mean, since March, we've had that banking crisis. 2-year, 1 year changed dramatically. In that time, interest rates have gone up a lot, so that's going to slow economic growth and it'll inevitably impact earnings as well. But then coming back to the issue of the US debt. I did read somewhere interestingly that the Treasury general account is to receive one-off payment of $145 billion at the end of June, which would ease the pressure. So all they need to do is bridge that 3 gap. They've done it in incarnations of the debt and sagas, where they prioritize spending on, pensions and benefits and on other things. I don't think it's going to be a significant issue, especially in the term, but I think what we need to be aware of, especially in terms of liquidity, is, the reason why we've had such a strong bear market rally since October, because liquidity has been running from the reserve account, which means they haven't had to issue so much debt. So when you issue the debt, it sucks liquidity out of the market. So if I'm winning the debt ceiling part, we could be in a very different liquidity setting in a few months. But I mean, my view is market, expensive, earnings are too high. We're only held up by a few stocks. We had negative earnings growth in Q1, but having that much expectation low. Just recently had they've beaten the stock 8%. So a few years back, we had a similar phenomenon where companies were low their earnings expectations, and then they beat it, and the stock would go up again. But classic for the market.
Good stuff. Arno, I want to bring you into the show, particularly from an FX point of view. It looks like the dollar, obviously, it's been in the doldrums for quite some time now, but if you look across the board, it looks like euro dollar might be topping out. Obviously, looks like the dollar index might be bottoming out. You've got a similar pattern forming elsewhere. Do you think that now is the time to be starting to get a little bit more bullish on the buck, or does the downward move have a little bit more room to run?
Well, mate, it's a challenging one, because I mean, if you take a look at not just the dollar, but cross-asset flows, if we take a look at the dollar, take a look at 10-year treasury yields, the S&P, gold, everything has basically just been range-bound over the past few weeks. We haven't really seen the markets being able, with any of the lots of catalysts that we've had, being able to break out of either the top or the bottom end of those recent ranges. So I'm just not sure what the markets can latch on to really get going from that perspective. I mean, we spoke about the data. In terms of the data holding up much better, I know I sound, like a broken record at this stage with that, but
I'm glad you said it. I was too kind to say it myself.
There's normally a divergence, right, between the hard data and the soft data, especially in this part of the cycle. So has the economy held up better than I thought it would at this stage? Absolutely. Do I think that necessarily changes the ultimate destination? Not really, just the timing of when that'll happen. The one thing that I can't really reconcile right now in terms of market pricing is the difference between pricing in cuts and the hopes of a soft landing. I just don't see how the market is currently priced for both of those things at the same time. I mean, if you look at equities, it seems like there's a lot of hopes for a soft landing. That's prevalent in the markets. But if you take a look at the bond market, and more specifically interest rate futures, the markets are pricing in or fully pricing into rate cuts by the end of the year. So it's weird to see both of those things happening at the same time. For me, it feels like there's a big risk of repricing on either one of those two spectrums, right? Either it's the bond market that's way too pessimistic right now, or it's the equity markets that's way too optimistic right now. So that is one of the challenges that I think we need to look at right now from a tradability perspective.
Arno, can I just counter that? And
yeah,
annoyingly, I can't score points on my own show, but you mentioned rate pricing, and I think I mentioned it earlier on in terms of the market pricing, 80 basis points worth of cuts between now and the end of the year, the December meeting. I wonder, and this is something I've been kind of mulling over for quite some time now, and I think Jeffrey's had a note about it a few weeks ago as well. I just wonder whether we're viewing rate pricing wrong. Because for ages, for the last 18 months or so, we've been going, 25 pips is priced, 50 is priced, 75 is priced, whatever. But actually, should we, and you can answer this question, should we view this more as a probability distribution? Between now and the end of the year, there are a range of outcomes which could range from an absolute boom in the US economy through to, the regional banking crisis spreads, Armageddon, get your beans and your gun and go and sit in an air raid shelter, which results in 300 basis points of cuts. So, you've almost got a range between 50 bip of hikes to 300 bips of cuts. Is this just the market saying this is the most likely outcome, and we're just in the middle of that distribution, perhaps? And that's why we see this weird divergence that you rightly allude to.
I think you are 100% spot on when it comes to that. I mean, any type of pricing that's further out than, to be honest, that's further out than a quarter is, wishful thinking, because there's so much that can happen. It all depends on how the data will evolve from here to there. If the labor market stays exactly where it is right now, which is not my expectation, but if that happens, then there's not going to be any need for rate cuts by the end of the year. So I agree with that. I think it gives us a very good idea of where the markets view the highest probability, like you said, from where we are now. But there's so much uncertainty between now and just the end of the year. I mean, we're in May now. Anything can happen by this time. I mean, the market seems, it's weird because the market seems convinced, at least from a probability perspective, that the Fed is done and that we're going to see cuts by the end of the year. Right now, though, I'm not sure what will convince them otherwise. I mean, could today's inflation print do that? I suppose that if it's very hot, that could see the markets increase probability for a June hike. But I think we're currently still at 90% odds of a whole decision. So it would need to be a monster of a CPI beat today. I think what would get the markets to view that as a lesser probability in terms of cuts is if we start seeing a series of higher inflation prints. Just getting one that comes in hot, I think the markets will be able to look through that fairly easily. It's when we get the next one and one after that and one after that. If you get 2 or 3 in a row that comes in hotter than expected, I think that's going to get the market's attention. And maybe that goes from pricing in, 2 cuts to maybe in just 1 cut. I mean, think about the jobs data. We spoke about the jobs data already. You shouldn't base too much of a conclusion on that anyway, but it was a very hot print nonetheless. I mean, unemployment came in at 3.4% again. Wages was up to 4.4. Jobs didn't look too bad. If that type of beat didn't even create a single change in terms of how the markets view rate cuts, I'm just not sure what will. I think it will need to be a series of data points. Now, when it comes to bringing it back to the dollar, how we can look to trade various asset classes with something like CPI, it's really tricky right now. The way that I look to trade the data is by always trying to find the markets where I think I'll have the clearest edge to trade with, if that makes sense. For the past few months, we've seen higher inflation being bad for equities, lower inflation being good for equities. I would assume that to be the case still. But again, equities have been all over the place. We've been seeing massive rushes to the upside, top of the range, then being sold back down to the bottom of the range. So I would expect that reaction, but it's not something that I would necessarily trade with a lot of conviction. The dollar, obviously, looking at the lack of reaction to the NFP print, I'm a bit hesitant of the dollar, but it will be a favorite to trade. I would expect a cyclical reaction. If it's a strong number, I would expect the dollar to go up. If it's a weak number, I would expect the dollar to go down. I think from a beat perspective, dollar yen is probably going to be a favorite for the markets, because if you're expecting the dollar to go up and you're expecting yields to go up alongside it, that inverse correlation between yields and the yen makes dollar yen an attractive long if we get a big print. But that'll be something that I would really trade only in the very short term. I don't think it's something that I would necessarily want to build a big position in, if that makes sense from a dollar perspective. I do think, though, Mike, that the cleanest trade right now could be yields. I think yields, if you take a look at let's just call it the last 4 or 5 inflation prints, yields have had the most, let's call it straightforward reaction to CPI data over the past couple of prints. So if we see a big upside surprise, I would expect upside for yields. A big downside surprise, I would expect downside for yields. And there's 2 ways we can trade this, right? The first one is just by trading bonds outright. There's various ETFs you can look at. I think the SHY is for 1 to 3 year treasury yields. You also get the IEF, I believe, which is for 7 to 10 year treasury yields. So those ETFs are ones to consider to trade if you want to trade the bond itself. But if you don't have access to ETFs, or you don't like trading the ETF route, you can also look at something like the yen, right? There's normally that strong inverse correlation. So if we see a very hot CPI print, again, dollar yen upside looks attractive. If we see a very bad CPI print, I would actually look to some euro yen shorts, actually, because I am short the euro. We'll get to that in a second, obviously. And if the yen has a reason to rally, I think euro yen shorts could be attractive if we get a big miss. But that's obviously just in the very short term, the way that I'll be looking to trade that.
No, good stuff. I think I'm going to get Arno a timer for the next time he's on the show to stop him hogging the limelight on the panel. But with all that said and done, let's continue our little world tour and get over to the Eurozone. So we've already discussed one of Ioan's favourite topics, which is the non-farm payrolls number. We're not going to cover his second, which is inflation this week, because that was a condition of him coming back on the show, not to talk about that. But we are going to discuss his third, and that is the ECB, because the European Central Bank raised rates by 25 basis points last week, stuck with their relatively hawkish stance, indicating that more rate hikes are to come. And Christine Lagarde and a whole host of other policymakers have sort of echoed that in interviews since the decision. Ioan, how much longer do you think the ECB can raise rates for? And more to the point, how much more in terms of tightening can the Eurozone economy actually withstand?
Yeah, it's interesting. I think, inflation in Europe is definitely looking a lot more sticky than it is, a little more sticky, than it is. So they'd be less inclined to go on that pause path, I think, when compared with the Fed and possibly the Bank of England. But I just want to go back to that point that you just made now on, rate pricing and whether the market's got it quite wrong. And especially in relation to the ECB, I thought it was quite interesting. So the market was pricing in, tightening around the time of the Silicon Valley Bank. The futures saw 3-month money rates above 4% in December. But by that March meeting with the banks in the US, that came down to about 3. So notwithstanding all the recent issues with First Republic and the broad stabilization of the banking sector, that's actually started to creep up again in the US, in the EU. So we're looking now. So we've gone from above 4% down to 3.5% to about 3.8% now. But this is still, about 30 basis points short of where it was, pre Silicon Valley Bank levels. So the market pricing wise, especially with the ECB, is whipsawed all over the place. So, if we look at where they are, I don't think they can do much in terms of, interest rates making a difference to the overall environment in terms of the euro area itself. You mentioned that the German data recently was very poor. Retail sales was slumping. Industrial production is just falling off the cliff. But having said that, vacancies are still, quite high, and a lot of businesses, they're quite reluctant to lay off staff, and this is despite some sluggish demand. So what this will then do is it'll add upside pressure on wages. So basically, output prices, will continue to increase, as the firms try to protect their real profit margins. So this type of combination will raise the risk that the domestically generated inflation then could stay really high even as external factors like energy prices coming down will help to reduce the headline rate. So this is especially true of the service sector industries. Backlogs are still climbing, and input prices and output prices are still increasing sharply. So I think they're in a quite different situation to the Bank of England and the Fed.
No, I think you're right. And of course, we all know how well the ECB tend to deal with different and difficult situations. Who else would you want at the helm in such a complicated environment than the perma-tan one over in Frankfurt? Arno, what are your thoughts on the euro? I'm going to give you 3 minutes.
Okay, timer starts. Okay. My view on the euro hasn't changed. If anything, I think the recent developments have just added to my conviction that the euro right now is on shaky ground. For the ECB, whether they will hike aggressively from here, like everyone expected, I don't think so. I think maybe 1 or 2 more left than they've done. They should have done a lot more sooner, and they didn't. And what's now happened is the growth story has started to catch up to them. The aggregate of information right now is pretty negative. Let's look at the things that created upside for the euro, right? We had yield differentials. Yield differentials has been in the price for the last few weeks. We've spoken about that. Been in the price for a while. And if you compare the yield differentials now versus just the US and the UK, that differential isn't favoring upside for the euro anymore. It's actually showing downside. So that advantage, I think, is well and gone. Then on the growth side, there was, for me, that was the biggest blemish, if you recall, going back to February for the euro, is that everybody got too excited about growth, at 0.1%, being this amazing thing. It's actually not amazing. If you're starting from 1 and you go down, that's okay. But coming in at 0.1, that's not something great to bank on. Now, if you take a look at the City Economic Surprise Index recently, we've gone from 99, I've got the numbers here, you've gone from 99 in February down to negative 20, and that was a few days ago. So City Economic Surprise Index shows us that there's been a lot of downside surprises in the economic data. Apart from that, yes, services economy is still doing okay. But manufacturing has really come down aggressively on the PMI side. That's not a positive. You mentioned German factory orders, which came in, I think, at the lowest or slowest pace in, going back to the 80s. So that shows you that growth doesn't look well at this stage. Apart from that, the euro remains a loved and a crowded long position, according to CFTC futures data. We now, with the recent Friday data, we moved into the 90 percentile going back to the last 52 weeks. So you've got a position that's massively crowded long. You've got a market that isn't paying attention to the growth story that's deteriorating. The reasons for the previous upside is starting to make its way out of the system. I still think that the highest probability for the euro is lower from here in the medium term.
Crikey, that's the most concise Arno's ever been. He can have a bonus point for that. And breathe, and take a breath, and have some water while Mr. Matthews speaks. Richard Matthews, what are your thoughts on the euro? I think I remember at one point you were even bullish euro, which must have, caused some sort of an allergic reaction. You're never bullish on the common currency.
I did feel very giddy after saying that. I went to see the doctor who took some sense into me. And in fairness, the euro has been second only to the Swissy or sterling as being the top performing currency in the G10.
I think the pound.
Sorry?
I think the pound has been the top
number one. I think the euro might be number 2.
Yeah, I think you're right.
But unbelievable. And as Arno said, it's a very, very crowded trade. People are looking at interest rate differentials. I actually think that it's struggling now. It struggled last week a little bit, so I think it could be topping out there. What I think is interesting, that I suspect we got the normal compromise fudge last week on 25 basis points. Germans came out very strongly yesterday. Nagel talking about more inflation and higher rates. Interest rates should rise further. Inflation's too high. Schnabel are typically hawkish as well. So I don't see them cutting rates. I think you could see another couple of hikes. I think the market's getting a little bit confused. They're watching the Fed, thinking the ECB and the Bank of England are going to do the same as the Fed. They're not. We're in completely different cycles. Inflation is arguably coming under control in the States, whereas in Europe, and even more so, which we'll come on to in the minute when my blood pressure zooms through the roof, in the UK, inflation is still much, much too high. So I think you're going to see more interest rate hikes in Europe. I think that the market is getting it wrong. They're looking what they're anticipating what the dollar's going to do. So I think they're totally wrong on that. The one thing I did notice yesterday amongst a host of ECB spokespeople was the German regulator coming out warning of a nervous time for banks and stress in the property market. And there's also another speaker came out hinting that they weren't entirely happy with what's going on with the banks. I wonder if there's something lurking beneath the water there, like an iceberg about to hit the Titanic in Southern Europe, and whether there are stresses on the banks down there, which we haven't seen yet, which makes me even more nervous of the euro. I'm never a fan of Southern European banks. And I just wonder if there was a little hint in the market there that something, or the hint yesterday that there's something untoward going to come out.
Well, there's not normally a lot to like about Southern European banks, apart from the weather, I guess. That's the only good thing about Southern Europe, and maybe the food. But before we get ourselves into trouble with Europe, which I feel we're very, very close to doing, let's get on to something slightly more familiar, which is the Bank of England. Right, now we've got Dick to stop talking over the introductions to each round. So let's actually get his views on the markets and the Bank of England. The BOE deciding policy basis point hike. Is there going to be any surprise from Threadneedle Street?
Well, I've got one word that comes to mind when you mentioned the Bank of England, but I suspect you won't allow me to use it. Rhymes with bankers, let's say that. A few pillars listing, and I bloody well hope he is. I, for one, feel a lot poorer, and thank you to the Bank of England and Andrew Bailey for doing so. I saw an interesting thing this morning that Adam Linton put up, that the Times shadow monetary MPC were expected a quarter point rise on a vote of 7-2. How is it going to be 7-2 when that idiot Penrayro's still on there? You know, he's saying 7-2 with 2 voting for a 50 basis point rise. She's probably going to vote for a cut, if not, staying where we are. I think we'll get a quarter point, not nearly enough. Takes us to 4.5%, the highest for 15 odd years or something. Whilst they whistle on about lagged effects and, veiled threats are going to make that higher and whatever. Interest rates in the UK are much, much too low. I've been going on, they should be certainly at 6% now. Inflation is 15, 16%, and we're dicking around at 4.5%. It's just absolute lunacy. I can't see what they're going to do other than a 0.25%, and they should be doing much more than that. I guess they're hoping that money supply is going to pull everything down. I don't know. I just give up with this country. Growth is, I've read someone's like an asthmatic snail crawling along, doing absolutely nothing. Stagflation certainly there. Yeah, and then you look at sterling, or the sterling, I should say. It's had 10 weeks on the trot up against the dollar. I mean, it just defies logic to me. Anyway, so that's it. I had a bloody long cold swim this morning trying to get my blood pressure down, and it's taken 40 minutes of recording this to get it going through the bloody roof. Anyway, the only reason to buy sterling is for King Charles's wonderful coronation at the weekend. That's the end of me.
Well, there we go. At least he ended on an optimistic note. Ioan, as Dick rightly said, cable has had a decent run of late. We're trading, north of 126 now. I think you said, 9-10 weeks. We've moved higher. How long can this continue?
I don't know. I mean, I do think, what's fascinating, especially in the UK sense, is like how sticky the inflation is. It's like we're fixated with, especially prices at the pump, where they go up like a rocket, they come down like a feather. So I mean, like the headline CPI rate. I mean, it's slow to come down. But I think the UK, I mean, it does. We do have a very specific. That 10% inflation rate. I mean, there are basically 3 categories that drive 70% of that. So we've got electricity, food price inflation, and then hotels and restaurants, which are basically, electricity and food inflation anyway. So,
and of course, Ryan pays his bar bill.
Well, that's perpetual inflation. That's, but I mean. As we know, I mean, electricity pricing in this country is bizarre. I mean, the way that they price off, the marginal price of gas. I mean, if you strip those out, the inflation pattern is quite sort of similar to the US. Traded food prices are, they're coming down significantly. That should eventually feed into inflation. I mean, gas prices have come off enormously as well. So, I mean, I think eventually we will see, electricity and Ofgem more, Bailey will need to raise. I mean, we need to look at, real rates and nominal interest rates, and, to be above inflation. But I think they have to control money supply. I think they've done that. I don't think they can do much, in terms of interest rates moving needles anywhere. So I think the main focus, not the base rate itself. I mean, the main focus for me will be the monetary policy report. I think the last one was February.
That's right.
Yeah. I mean, that was much less downbeat on the economy than it was in December, and we saw a real contraction in real GDP. Is provisional due out on Friday?
It is, yeah. Friday morning, 7:00. What a thrilling end to the week.
Oh, yeah. So, I mean, growth's still possible. I mean, absent any revision. So I think we need, monthly fall of about 30 basis points for us to get a quarterly decline. But having said that, I mean, there are other factors that we need to consider as well. I mean, all the strikes that are going on, I think we've lost something like, 560,000, working days, which, would have impacted total output as well, to the upside. So, overall, the economy is lethargic, and I think any upswing is lopsided. But I mean, I think we're probably in a little bit better shape than Europe going forward.
Yeah, I think you're right. And I think the other point, and I don't want to steal Arno's thunder, but I'm going to anyway, is the point that you made last week or perhaps the week before in terms of, we're in better shape than our peers, but also the economy, although it's not stellar in terms of performance, it's better than the very, very low expectations that we had coming into the year, which I think is another reason why, I think 5 or 6 sell-side banks are now getting bullish on the pound and bullish on the UK economy, which does worry me a little bit. Arno, let's bring you in. 25 basis points, a 7-2 vote. Cable, do we see 120 or 130 next?
Oh, man. Yeah. Look, 25 is
start your timer again.
Let's start the timing. 25, I think the most likely, look, they should have gone much more aggressive already, like Dick said. They probably should have been above 5% already. I mean, we've got double-digit CPI. Wages increased at 5.9%. Food inflation crazy high. Rental prices are going up. The labor market is doing very well. Unemployment at 3.8. Another 160,000 jobs added. So I think they can afford to go 50 tomorrow, but we know that a 25 is probably the most likely because they have been very reluctant to hike. Obviously, what we think they should do and what this bank ends up doing can be completely different, So I think the first risk for the markets is if they don't do 25, right? If they do 50, that's going to be an obvious opportunity to get long sterling or more long sterling. If it's a hold decision surprise, then obviously that's going to be your first trigger for a possible trade to the downside. In terms of what Ioan said, I think the most important thing, assuming we just get a 25 tomorrow, I think the most important thing for the markets will be what the NPR has to say. Obviously, the vote split will be in focus. If we get 7-2, I don't expect any real reaction to sterling on a 7-2. If we start getting something like a 25 hike, but a 6-3 split or a 5-4 split, obviously that can see some of the recent strength in sterling coming down. I'm not calling for that, just saying that that anything is possible with this bank. So be ready for that eventuality. Make your list. If you see 6-3 or 5-4, that could see that a 25 actually be seen as a dovish hike. So watch that on the vote split.
So just on that vote split, we've got to be careful with this because there's been such a merry-go-round of MPC members that we don't know what we should be factoring in. We don't know whether doves or hawks are coming in. So we've got to be careful, especially with Green coming in. She like an economist, Canadian economist, is she?
Yes, she is. Yeah.
We don't know these views, so we've got to be careful when we look at the composition of the vote itself. So, yeah. I'd be hesitant to make any trade in or take any trade in position. Sorry, based on that itself until we know what these new people are, their thoughts are coming in.
Yeah, yeah, and I mean, the good news is we'll be able to see. Oh, sorry, Dick.
Does that mean you can totally ignore 10 Ray Rose votes and when you're looking at things, and actually we should be looking at 8 votes, not 9?
Probably, right? Yeah, because
it's irrelevant after this month.
Yeah. Exactly. She's almost got a free hit to vote for a cut if she really wanted to, because, as you say, she's got 2 meetings to go.
Don't mention free hits and 10 Ray Row when I'm in the city this afternoon.
I will alert the bank to your presence. Arno, I think you've got about 30 seconds left on your timer.
Okay, so the other focus, the NPR, right? I think that for me is going to be, like Ioan said, the most important thing to take away, because that's where the bank will give us their guidance on where they think rates go next, right? So let's just assume we do get that 25 basis point hike. What do they think is going to happen to rates going forward? Currently, the market's as it priced at 4. We had 4.89 at the moment. So if assuming we get a hike, that means one more hike priced. If they wanted to guide against that, obviously they will do so with the inflation forecast. So if we see a very strong undershoot in the inflation projections, that'll signal that maybe the bank is ready to start pausing rates, even if they don't want to make that very clear from a language or a rhetoric perspective. If they project a massive undershoot in inflation, that'll give us a signal that they don't maybe think they're going to go with another hike. And that can obviously see some of the recent froth we've seen priced into sterling coming out. On the other side of the coin, if they have changed their mind about expecting inflation to come down aggressively from the summer months, and we start seeing that looking more like an overshoot, then maybe the market starts pricing in a terminal closer to 5%, which based on inflation, in my mind makes more sense. And if we see that, that can see some additional strength for sterling. So I'll be looking at three things, whether they do 25 or not. Obviously, the outlandish call would be for a 50 or a hold. And obviously, we know how sterling will react. I'll be focusing on the vote split as well, but more importantly, what they have to say about those inflation projections. Is it an undershoot? Is it an overshoot? And then obviously, like Ioan said as well, the growth story is important. It's growth isn't stellar, but like you mentioned, and like we've been saying over the past few weeks, it's been better than what most anticipated. So if they do come in sounding slightly more optimistic on growth alongside inflation looking, like they might overshoot a little bit, then that could obviously create some tradable opportunities as well. But those will be the main focus points, I think, for sterling going into tomorrow.
I think that's a really good framework through which to look at it. I just want to make one last point at the Bank of England. It is a bit of a rant, but this has annoyed me for donkey's years now. The Fed dot plot, it's not great, but at least it's clear where they think rates are going to go. The Bank of England signalling where they think rates are going to go based on the 2-year ahead inflation forecast subject to market rate pricing. Come on, guys. Central bank transparency, communication, you're all about improving it. Do better. It's not hard. Round 4.
They couldn't do dot plots.
No, they couldn't work out how to do it.
Exactly. Thank you. Do you feed me the lines?
Let's get on to the last round. Right, Arno, I'm going to kick off with you here. I want to talk about regional banks in the US. I'm getting bloody tired of talking about this, to be honest with you, but it seems like every week at this stage, someone else is going bankrupt. Of course, it all started with Silicon Valley Bank and a couple of, I think, Signature Bank were the other one that went towards the start of March. Then we had the shenanigans going on with First Republic. They got the capital injection, then they ended up getting bought out by Jamie Dimon and JP Morgan, of course. Last week, it was PacWest. They had a bit of a wobble. I think their shares were down 80% year to date at one point. The market nerves seem to have been soothed a bit there. But how does all this end? I mean, we surely can't go on with a situation where every week or every fortnight it's another bank coming under pressure. Is the Fed going to do something? Is Jamie Dimon going to get his checkbook out again? Well, what's the end game here?
Yeah, look, I think the boredom that we have is to blame because of financial media, right? They are trying to squeeze every single second out of this what they can. So we're being bombarded, which is causing a lot of frustration with it. But in terms of how long this can carry on, in my mind, I was looking towards something like that blanket deposit insurance, right, as being like the silver bullet to try and just fix everything for this. However, I read some interesting research from Jim Bianco over the weekend, which made me think a little bit otherwise. So I thought, okay, if you stop the concerns about deposits being guaranteed, then obviously that should stop some of the outflows. But he made a really, really good point. He said that, listen, even if we do provide that support, that blanket insurance or guarantee for deposits, the big problem isn't that they feel unsafe, just that. The big problem here has become yields in terms of the public side, because with money market funds right now offering, 4 to 5%, the very low, less than 1 or just above 1% that the banks have been offering, that's just not going to cut it. So even if we do get something like a blanket deposit guarantee taking place, the whole saga that has been the bank's failures has brought the public's attention to, hey, I'm getting super, super low interest on my deposit. Why not just take it out and move it away? So he's of the opinion that even if we do offer something like that, yes, it might provide some solace, but is that really going to stop the public now frantically looking for wherever they can get higher yield? And I think that's really a big risk for regional banks, because if the deposit outflows continue, the stress on the banks will continue unless they get big injections from the Fed or from other banks to try and, keep them afloat. But, you also have to look at it from the big bank perspective. You mentioned Diamond there. Why not just allow these banks to offer you an opportunity to buy them at very, very low prices? So I don't think they're going to be as keen to jump in like they did last time. It's going to come down to the Treasury or the Fed to help them with actual injections to try and keep afloat if the deposit outflows continue. But I think it was you, Dick, that brought up the fact that there's something like, how many banks? 5,000 banks?
There's 4,000 banks.
Or 4,000 banks. So, at that number, I'm not sure whether a few of them going away is really going to change much. Obviously, yes, it's going to be a problem for the equity holders. It's going to be a problem for those involved. But if you take your deposit out, from a public perspective, if they were getting 0.5% and they're now going to get 4%, is that really going to see them, stressed about a regional bank going away? I think that's something to think about. I think that means the risk could continue for longer. As long as they don't offer higher yields. And I mean, much smarter people than me about the banking system has had some pretty fantastic research recently saying that the banks can't afford to. They can't afford to, match something like money market funds. And until they do, why would you have your money in a bank like that? Personally, even me, I've moved funds into money markets a while ago already. So why would you want to have your money there? I think that's a real problem for them to consider.
I think, Arno, sorry, I was going to say, I think South African banks, you're better off having it, under the mattress, aren't you?
Yeah, well, look, we've got some pretty good money market funds as well. It's just if I can keep the electricity on to get the money out of the bank when I need to, that's the real concern. But yeah, I think that for me is something interesting that I didn't really think about, Mike, is that, even if we get this amazing blanket guarantee, will that stop people looking for yield? And right now, I don't see that happening. So I think the problem has room to persist as long as deposit outflows continue, which looks likely right now.
No, I think that's a really good summation of the situation. And of course, you've got to think of it from the point of view, if you're Jamie Dimon, if you're Brian Moynihan at Bank of America, and you're sat there and Treasury or the FDIC are going to insure 80% of your losses for buying these high net worth deposit bases, why the hell are you going to say no? You're getting it at a knockdown price. And at the end of the day, in 2 or 3 years' time, you can afford to hold these portfolios to maturity. It's going to boost your earnings and your profitability. Ioan, what are your thoughts on this at the moment? Are you with Arno that this could rumble on for some time to come?
I do think it could go on, but I think there are a lot of different facets that we need to look at in terms of this. I mean, initially, if we think about it, we are seeing the weakest banks that go into the wall, but the problem is, that the market goes on muddy waters and then looks for the next domino, right? So, but I mean, if you look at it in terms of, especially deposits and, capital ratios and, asset and liability durations, whatever, PacWest was nothing like as bad as, Silicon Valley Bank and First Republic. So, I mean, we could argue that the market's been quite rational about this, and they're just basically taking up the worst banks in the US. And as we mentioned, there are 4,000 banks in the US, which is unsustainable, right? So there's probably going to be. I mean, they've already started blaming Trump about the Dodd-Frank Act and how the banks are now reacting now. But again, like Arno said, the issue is that deposit rates in the US are too low. I mean, they're too low everywhere. You can buy short-dated treasuries up to 5%. So households are making that that rational arbitrage and asking, why am I only getting 50 basis points? Not everybody in the US, trades on their accounts all the time, and some are comfortable and will leave it there. But the nuclear option would be a rate cut, because the banks, they can't raise the deposit rates because that'll undermine their profitability, and in such a big way as well. So, a lot of these business models were, predicated on, cheap money, basically, funding their loan books. So this is the other facet that needs to come into play now. So it's not just, deposit flight. There'll be, I mean, for instance, treasuries. I mean, they'll have to mark treasuries down, 20%. Their loan books are going to come under pressure because all the assets that they've lent against will have to be repriced lower. I mean, the example of this is commercial real estate and high vacancy rates. So it's much broader than deposit rates. So there's probably more to come, but I don't think it's predicated just on deposit flight. I think as a result, credit conditions will probably tighten up, and the economy will come under pressure.
No, I think that's a really good way of looking at it. Mr. Matthews, let's wrap up the show with you, just tying things together on a bit of a broader level. Ioan rightly mentioned about tightening credit conditions. Two questions really for you, mate. Firstly, what impact is that going to have on the economy? Is it going to be effectively a 50, 100, 150 basis point hike, the effect of that in terms of slowing growth? And secondly, in terms of the equity market, all this has been going on, but the S&P has still been just stuck at 4,200. What is going to give the market a decent shove lower, or even a decent shove higher?
I think that actually credit tightening credit is really going to impact, and I suspect it'll probably have an impact something like 1.5% in terms of interest rates. I do agree with Ioan actually about the commercial real estate. I think that there's a lot of hidden problems in some of the in the banking system in the US as much over here and in Europe, and I don't think we've seen those stresses yet. So I suspect we're going to see more banks with problems, and it's not just going to be deposit flows out into money market funds. It's actually going to be their loan book, and I think that's a big problem which hasn't come up yet. I personally would let the banks fail. I think it's a moral hazard there. If you can do what you like, so the Fed's going to bail you out, then you're going to do what you like, and you're going to get toxic banks. We've come down from 18,000 in the 1980s down to 4,000 now. How many banks does America need? What's the comparison with Europe? That'd be interesting to see how many banks there are in Europe compared to the US. So there's still too many. Still think they're going to come down quite a lot. As for the S&P, it defies logic. I wonder how much of that is actually just real day traders pushing the market up. I tend to think, as opposed to professional traders who may well be standing back. And it's also a very, very tight window, isn't it? I mean, I don't know how many equities make up the S&P in terms of value. Apple must be a huge constituent. I think Apple's almost as big as the whole UK stock market now, isn't it? The valuation of it. So you're really only trading maybe half a dozen stocks in there. So I am very, very wary of trading the S&P. And just to close, it's quite interesting, just going back over what we talked about today. Very few of us can see a reason to buy the dollar. Very few of us can see a reason to buy the euro. And very few of us can see a reason to buy sterling. So what should we be looking at? Gold, Swissy, the yen? It's interesting. We've destroyed all the three between us, and we all tend to agree on this, all the three major currencies that we normally talk about, which is an interesting point. Anyway, that's my lot. Have a good day.
So just in Europe, there are over 5,400 banks.
There are.
Right.
In the EU, yeah.
Right.
Jeez.
Wow. Okay.
A lot of banking consolidation to come. I think Dick's point is a really nice way to end the show. So let's have a look at the final scores. So, hard luck, Dick. I will bring you a wooden spoon and buy you a consolation tonic water a little bit later on. Arno in second, and Ioan, congratulations, returning to the show after a couple of weeks and romping home with a victory. And he's so stunned he can't speak.
I was waiting to be like, I thought there was another graphic coming up with like balloon
Unfortunately, no graphics, but it was obviously your lucky leprechaun mascot in the picture frame behind you that helped you to the victory this week. Well, that brings us to the end of the show. So thank you to Arno Venter, Dick Matthews from Pardus Effect, and Ioan Smith as well for joining us. Also, thank you to our producer, Kyriakov, for bringing this together so brilliantly, as he always does. We will be back again with another episode this time next week. Thanks for watching. Goodbye for now.